Welcome to my presentation on the accounting journal and its application in double entry bookkeeping. Just a quick introduction to me. I am AAT qualified and completed levels 2, 3 and 4. I've been working in finance now since 2016 and fulfil my passion for teaching in supporting others through these videos. My aim is to help students understand the key concepts of the AAT course, so I have created my own materials to show the way that I learnt. As these materials are my own, I must state I'm not endorsed by AAT, simply a former student wanting to help others with their accountancy studies. I hope these are beneficial to you and wish you good luck and success. Okay, so we're going to start then just by looking at what exactly a journal is. So, it's a book of prime entry. So just like you have your sales day book and your purchase day book, they're your books of prime entry. And the journal is a book of prime entry for non-regular accounting transactions. So what's the process? Well, the process behind this is that the journal will record the transaction before entering into the double entry bookkeeping system. So this means, like when you have your purchase invoice come in from a supplier, you record it in your book of prime entry and then it gets entered into the system. It's the exact same thing, except these are for things that are non-regular. So it's going to be your sort of emails and letters that you might receive for adjustments. It's going to be irrecoverable debts. It's going to be payroll entries, anything like that there isn't normally an actual document for as such, but this is about recording the transaction before entering it into the double entry bookkeeping system. So we can see here that we're going to have the non-regular transaction at the top there. And as I say, this could be a financial document or it could be something like payroll. You've got the journal that you create, which is your book of prime entry. And then the double entry bookkeeping happens after you've done the journal, which gives you your debit and credit entry. So why do we need them then? Well, it kind of acts a little bit like a notebook. So the book of prime entry, the journal book of prime entry acts like a notebook. So it makes a note of things that you might forget about, or you might not know, remembering, a few months' time why you've put a transaction through. So it's a little bit like a notebook. It reduces the risk of errors and fraud. So in a lot of companies, journals will have to be approved by managers before they're actually entered. So this means that they're not only going to be checked for accuracy, but it also means that the risk of fraud going through, so therefore fraudulent transactions being put into the accounting system, more likely to be picked up because they're being checked by a manager. And lastly, it's also a form of audit trail. So for all those sort of irregular transactions that need to go through, ones where we haven't got invoices, anything like that, it acts as our audit trail. So you can always follow it back. So once the journal's in and posted, you can then follow it back to the book of prime entry, which will then give you the more detail on the entry. So what are the key elements then of a journal? Generally speaking, layouts can vary between companies, so it depends on the company and what their process is. Your journals might look ever so slightly different, not vastly, but just the columns and things that you need to use might look slightly different. But in general, there is a sort of standard, and it should usually include the following things. So you need to know what date you're going to be posting it, the descriptions and details, a reference or a nominal, so that could be a code that you need to post it to, it could be staff initials, it could be project related, anything like that that might be of a reference for that particular journal that would be useful. And then obviously you'll have your debit and credit values as well. And of course, our journals must always balance to zero. So our debits must always equal our credits, which is one of the key things of double entry bookkeeping. So as an example then here, I just want to quickly show you what it might look like. So this business here has had some bank charges in July. So we've got our date here in the month that we're going to be posting the bank charges. We've got the accounts that it's going to be affecting. The reference here is just that it's in the cash book for the bank and it's in a general ledger for the charges. So this is going to the charges account. And then you've got your debit and your credit. So the bank charged us £15, so it's left the bank account and it will go into the expense account for charges. So that's your basic one. So moving on to what journals might be used for. Journals are regularly used for opening entries of a business. So when you're starting a business, the opening entries are needed to show the starting assets and liabilities. Okay, so when a business starts, you're always going to have your starting assets and liabilities. So these are going to be your opening entries. So just to go through an example of this then, you're a trainee accountant at practice and you've received the following information about the assets and liabilities of a new business at 1st of August. Draw up the journal required to enter these into the double entry system. So here then you can see we've been given the different amounts that need to be entered as opening entries for this new business. So I'm going to bring up a little table which I've just set out so that we can then talk through it. So this is the table that we're going to see. It follows the same format as the journal entry that we saw previously. So now we can go through and we can fill it in. So just to start then, let's look then. We've got cash in bank here, we've got inventory, we've got supplier accounts, computers and capital. So already here you can see that I've populated the accounts just to save a bit of time on the video here. So we're going to have our bank account, we're going to have an inventory account, we're going to have our purchase ledger control account, our computer account, and then our capital account. Now before we get started here, it's worth just saying that the capital account here is a little bit like a balancing account, because you've always got to have your accounting formula balancing. So to do that, you quite often have to have a balancing figure, and in this instance you can create the capital account by using that. So your accounting formula of capital equals assets minus liabilities. So you're going to have your capital equals assets minus liabilities, whoops. And that's how you're going to get to your capital account. Okay, I'm going to focus on drawing up the account rather than the actual equations to get there, just so that you've got the process of how to draw up a journal entry. So let's start then with our cash in bank. So our cash in bank there is going to be our debit balance. So we're going to put £1,000 debit there. Our inventory, we've got an inventory of 5,000, so that's going to be an asset as well to us. So that's going to be our debit balance. Now our supplier accounts is money that we owe to suppliers. So that's going to be a liability account. So that's going to be our purchase ledger control account. So you're going to have your 1,200 balance there. Your computers are usually fixed assets, so therefore they're going to be an asset account. So that's going to be a 2,000 debit balance there. And then your capital account is your balancing figure of 6,800. So you can see that if you then add this all up, you've then got 8,000 here and 8,000 here. So both your debits and your credits equal each other. Okay, so all of your journals must equal each other and therefore balance off to zero. Okay, so another entry that may go in then through journals that you might have to process will be your payroll. So it's a step-by-step approach to record the wages that have been paid, national insurance contributions, PAYEs, and other contributions such as, you know, trade union membership fees, etc. So we'll walk through an example. Now, just to say, in this video, I'm just going through the basics of putting the journal together. There will be another video that will show how the payroll is actually worked out. So how the figures that we get to in the journal are actually put together. So this is just identifying what will be a debit and a credit. But I'll actually go through the steps to calculating when you're given these figures that you can see on screen at the moment. In the other video, I will go through to show you actually how we calculate those journals. So you're a trainee accountant at practice and you've received September's payroll information to enter into the system. So you need to create the journal to do this. So you're given here a whole set of numbers for the different elements of payroll. We're going to move on to the next slide and we're going to pop them in the correct parts of the journal. So bringing up the information then that we were given on the previous slide, and also a table which we're going to talk through as well before we put the figures together. So we've got all of our figures here as to what was involved in the payroll for September. And for each payroll journal, we'll have a wages control account and an expense account. We're going to have a bank, HMRC, and an employee pension. Now, as I said previously, there is going to be a more detailed video focusing solely on what figures go into creating these journals, but just for the purposes of drawing up a journal, I'm just going to pop the figures in the way that it needs to go in to balance it off to be able to post it. So our wages expense account then, so that's going to be what is the actual cost to the business for September's payroll. And that actual cost to the business is going to be £17,850. And the other side to that is going to be our wages control account. Okay, so that's effectively our liability, and that's our expense account. Okay, so again, with your double entry, always look at your types of accounts, and I have got other videos on double entry and types of accounts as well, to make you understand the difference between debits and credits and what accounts and why they're applied. So now you've got this sitting in your wages control account, you've got your 17,850 sitting in your wages control account. By the rest of these journals, we then need to balance that off to zero. Okay, so that's holding it as our liability, and now we're going to pop it all in the correct pots effectively. So the net wages then, well, the net wages is actually what is paid to the employee. So that's what goes into their bank account as their monthly salary. So that's going to be their net pay. So we're then going to debit our wages control account, the net pay figure, and credit the bank because it's coming out of the bank and paying our staff. We then have to take into account what our liability is to HMRC. So again, we're going to debit the total amount that's due to HMRC, which in this case is going to be 6,300. And we're going to credit the HMRC account because that's our liability. That's what we're saying. At some point, we're going to pay them. And then likewise, our pension, we're going to take 1,500 into the control account, debit that into the control account, and then it enters our pension liability account because that's what we're going to have to pay going forwards. So then you can see that if you were then to add up your debits and your credits, it will come to 0. And your wages control account here, your 17,850, is debited 10,050 for your net wages. It's also debited 6,300 for your HMRC account, and then 1,500 for your pensions. And those three there is the same as 17,850. So when you look at your wages control account, which I'll go through in the separate video, those two balance off. And that's how you produce the journal for your payroll monthly. Okay, so the other time that you're likely to be using journals then is to record irrecoverable debts. So when a business is going to be unable to recover debts from a customer, these need to be entered into the accounting system to write them off and to adjust the sales ledger account. Okay, so this is like an adjustment going through because the customer's gone bankrupt, you're not going to get any money from them, so you've got to remove it from your sales ledger account. It will be written off into a bad debt or an irrecoverable debts account, and we need to do that via preparing a journal. So just to walk through it then, an example of this would be you're an accounts assistant at a VAT registered business and have been advised that customer RT45 has gone bankrupt and is now unable to pay their £2,640 balance. Prepare the journal required to enter this into the accounts as at the 31st of October. So again, I'm going to bring up a little table now that I've already created, and we're going to walk through it like we have done before. So 31st of October is our date. Here's our description of what the journal's all about. Okay, so the balance of customer RT45 account write-off due to them going bankrupt. And then we're going to have 3 accounts here that are going to be affected. So the key in this bit of information that we're given is that we're told that we are an accounts assistant, at a VAT registered business. So that means when we raised our sales invoice to this customer, we would have charged VAT and therefore we would have paid it over to HMRC. So therefore we're going to have to then claim that VAT back. Okay, so we're going to have an irrecoverable debts account. So that's going to be our expense account. We're going to have a VAT control account and then our sales ledger control account. So let's look through at how we're going to enter this. So the first thing we need to do is work out what the net value will be. So depending on how you like to work out your VAT, you can do it sort of fractions or decimals, entirely up to you. My preference is the decimal way. So I would do £2,640 divided by 1.2, and that gives you a net value of £220, and therefore your VAT amount is going to be 2,200 multiplied by 0.2, and you'll get a £440 net VAT value. So now we know what these are. Your irrecoverable debt then. So your irrecoverable debt is only going to be the net amount that goes through because that's actually what you've lost in the business. Okay, so you're going to debit that as your expense account, your net amount. Now your VAT control account, now usually when you put sales invoices on, you will credit the VAT control account because it's a liability, you're going to owe it to HMRC. So now, because we're going to reclaim it back, that means we can debit that account to take it off what we owe them. And then our sales ledger control account holds all of the money that that customer owes us. So we're going to then credit that in total, and that balances off the journal. Don't forget as well, you will have your subsidiary account for RT45. And you'll also need to credit that as well, because that doesn't form part of the double entry bookkeeping, but you will need to remember to do that part of it as well. Okay, so just some final thoughts then and a recap on what we've been through. So journals are used to enter non-regular transactions into the double entry system. They're useful to create audit trails and reduce error and fraud. And they also act like a little bit like a notebook as well, okay? So it helps you remember why the transactions were put in the first place. They're commonly used for your payroll entries and your irrecoverable debts. And remember, they must always balance. So I hope the video has just given you a brief overview of what a journal is and why we use them with a couple of examples. As I said regarding the payroll, I am going to do a separate video on that and to work out what goes into the figures that we used earlier. And that just leaves me to say good luck in your studies, and I hope it all goes well for you.